My taxes definitely going to be past due anytime soon now. Flip through this and take a look at that. Those are some write-offs, I believe the term is.
I mean, it all looks pretty normal here. Is this a Chinese food menu?
That is not a write-off.
Is that a business expense?
I'm just gonna. That's
okay.
Gonna be me.
Perfect. Is that a headshot?
Yeah. Is this headshot?
Well, I think you're gonna need to call somebody a little more professional than me for that.
On the mic with Todd Giuliano. Presented by DJ&Lindsey.
He's roaring. Welcome back. We are on the mic. I am here with Wes Graham of Cross Country Mortgage. Cross Country Mortgage, one of our partners and one of the top lenders in the country. We're so thrilled to have you back here today. We're talking banking collapse. We're talking all this bananas that everyone's talking about, and the whole world's in a tizzy. But let's kind of get into just a little cross country mortgage plug. Let's just hear about you guys for a little bit.
Yeah. So definitely. One of the more sizable lenders in the country, but we are privately owned, which I think is something that really shines through. I think we make a lot more sensible business decision calls than when you're kind of driven by share price sometimes, and which we'll get into with some of the banking stuff. If there's anything that we really excel at, it's just really kind of being the smartest guys in the room. Mm-hmm. I mean, not the Enron situation, but just really. We've got professional loan officers, professional processors. We hire the right people. And so, as far as a real estate partner, we do a lot of purchase business. And to me, a lender who's qualifying more of your buyers, certainly the weird buyers. Like I just did a yachty a little bit ago, the stewardess, below deck style.
Love that.
International income, super in euros, but paid through the Caymans. I mean, what you would expect. And, it's something a lot of lenders would have gone, no way, right? But so for a real estate agent, having a lender who is qualifying the weird ones, giving you more at-bats, certainly in this tricky market.
Sure. And
then beyond that, really making sure that a loan is going to work. And then even the easy files, once you're under contract, stuff happens.
No
inspection
doubt.
issues, whatever. And so really having that agent, lender, buyer relationship, that communication,
right,
to really strategically take advantage of a market where sellers are having to negotiate a little bit now.
Sure.
I just think it's key because it makes sure everybody's getting the best out of the situation.
Right.
And not having people walk away because.
Yeah. I mean, we hear stories all the time about, XYZ lender couldn't get it done. And obviously we have the BAT line. A lot of our agents, have their personal number. And one quick call over to CCM and we get it sorted out for the most part.
Yeah,
fairly quickly.
And if it doesn't work, on the same
shoot you straight.
By the same token, we're shooting people straight, helping them get to where it is going to work, but we're also making sure people aren't throwing money at inspections when it's just not time.
Right. And I mean, I think the main goal of just any agent partnership with a mortgage lender is that we don't get to the closing table to find out that it won't happen.
Once that earnest money is gone.
Yeah, right, exactly. So let's get into banking collapse. We have our chief economist here, Coop. He's brought all his paperwork, all his stuff he needs to do his due diligence. But I think it's important that people understand just a quick little education first. And I think if we want to touch on just the principles of fractional banking, right? Like how just generally works, right?
Sure.
How you go to the bank, you give your bank $100. Realistically,
where's that $100?
Right.
Yeah.
So let's just walk into that.
Yeah, and I think kind of stepping back a little bit because I think let's keep things simple and then we can rabbit hole because there's some very funny rabbit hole with all this stuff. I think framing things with what Powell came out and said yesterday, I think is kind of a smart way to go about it because if you don't know. Yesterday, we did go ahead and raise interest rates again, 25 basis points. Important to know the mortgage market, that's not a direct correlation to loans. Expectations of what the Fed is going to do is really what's already priced in. So barring any surprises there, usually that kind of thing's already accounted for. But what Powell came out yesterday, and of course he addressed the Silicon Valley Bank issue, the various other issues going on in the banking environment, and framed them in the context of, what are we expecting the Fed is going to need to do with interest rates, and what that means for the economy, what it means for kind of general contagion, that contagion fear.
Yeah.
Which again, we'll go into a lot more depth on that, but. by and large, banking system, this isn't 2007. At least there's no indication of that yet.
I think that's what everyone's main concern was.
Yeah.
Right?
We'll get into some of the nuances with Silicon Valley Bank in particular here in a minute. But he kind of really did an amazing job of sitting right on the fence yesterday of, hey, we still think tightening is needed because inflation is not gone. We're not where we're supposed to be. But at the same time, did, give a nod to the fact that once we see banks starting to struggle, that theoretically should lead to some tightening in overall credit conditions.
Right.
Which, if that's the case, you don't necessarily need to continue raising interest rates as banks kind of getting a little more conservative, getting a little more afraid to lend, is more or less accomplishing the same goal.
Right.
So you don't want to have those. You don't want to double down when you're kind of getting the result you want. But so fractional banking and just, what happens to your $100 when you put it in the bank, right? Banks do not have hundreds of dollars in cash, whether in, cash or cash, or, electronically held. They don't keep that cash.
Right.
Because for a bank, deposits are a liability.
Right.
They have to pay FDIC insurance for that money. They theoretically might need to pay interest, although we haven't seen much interest paid in the last, 15 years. So that's kind of feels kind of alien these days. And they've got, compliance costs. They have to service those accounts. They have to deal with statements. They have to issue debit cards for every time somebody loses them. So, that's expense. So, a bank's operating model is they have to invest that money somehow. The old school business model was, they'd make mortgages, or they'd do commercial loans, or they'd, do the vanilla stuff you expect a bank to do.
Right.
It's a Wonderful Lifestyle, right? And what's changed in the banking world is that, banks now are doing all kinds of stuff.
Right.
They're in investment banking. They're in, so new public offerings for new, companies going public, or, buying various securities and different investment instruments. Because at the end of the day, those deposits are a liability to the bank. They're a tool. They have more deposits. That's more money that they can then put out for their profit centers. But, those profit centers have to offset those and all their payroll costs and everything else. And so that's where these various other, endeavors come from.
Right.
And so the way, though, and obviously the Great Depression and the bank runs of the Great Depression, which is kind of what is the fear,
The fear,
my Christmas Eve tradition is It's a Wonderful Life with a glass of scotch after the kids are in bed, and that's that perfect classic example of a bank run, right? And so if you haven't seen that movie, you should see that movie, but that's what a bank run is. And so, there was a thought that all these loans at the time, because they weren't investing like they do today, all these loans might go bust because of the Great Recession. And so that got people panicked because all the cash that they had put into the bank for mortgages that were supposed to be paid back to the bank now isn't secure. Well, the bank doesn't have your money. So people they would physically, and actually there was photos of that with Silicon Valley Bank last week. They literally run to the bank
to try and pull
their cash out. Well, that cash isn't there.
Right.
And so, the regulatory infrastructure has had to get much, much more complicated as, it's not just mortgages anymore. It's not just all the other vanilla stuff they used to do. And so, today, the requirements for banks to, hold assets that have certain liquidity value, right, in the event that, our deposits are leaving and we need to shore up our cash position, our actual deposit position, means we would need to liquidate other things we have. Well, all that's on margin, right? All that is borrowed. And that essentially, right? So you think about what happened to FTX, it's the same thing.
Right.
Really.
I just think it's important to note that when you talk about cash, you're just talking about liquidity. It's accessible funds in any.
Right. And so I guess, it's important.
It's not physical like dollars sitting in a vault somewhere.
Right.
It's just accessible
immediately
funds.
They can.
Right. Not I have a car that I can sell to get money. It's I have this money.
You need to make payroll Friday. We have that available.
Yeah.
In your account, right?
Correct.
You can make payroll, which again was part of the concern with SVB. And so the thing that's tricky is that, again, they can invest in all sorts of things, and different sorts of things are treated differently and this is, regulatory.
Right.
Different types of security instruments, different types of assets, if you will. Some of them get face value. So if you have, in the case of SVB, if you have U.S. Treasury debt or mortgage-backed securities, or what are things that are traditionally considered to be very stable,
right,
and also liquid. There's a market for them. They're easy to sell and quickly. It's not like you have to sell a house. They basically get dollar for dollar, and the problem with that is that while those things are valued at dollar for dollar, it's
not always the case.
It's not always the case.
Right.
And again, we can really go down that rabbit hole. But I think the kind of important thing to start off with is specifically Signature Bank, Silicon Valley Bank, First Republic. These
right.
Credit Suisse, maybe a little different.
But their general exposure of where those funds were, I think, is the big risk that not many people are understanding.
Right, and the fact that those exposures were hyper sensitive on both sides of the balance sheet. We're hypersensitive to interest rate risk.
Right.
And what interest rate risk is in a broad sense is, let's say that I am guaranteeing my deposits with U.S. Treasuries, right? Well,
so again, not liquid cash. You're just guaranteeing, hey, we have this funds. It's purchased bonds, which at some point will turn into that cash.
Right.
At any point in time.
Right.
You don't want it to do that at any point in time, but that's theoretically how it's supposed to happen.
Yeah.
Got it.
And the thing is, U.S. Treasuries are liquid. They are highly liquid, right? But the problem is with interest rate risk, what that really is, let's say I bought a bond today for $1,000, and that bond pays 5%. Okay. Well, that's going to pay me $50 a year for till whatever the maturity date of that bond is, and then when that bond matures, say it's 10 years from now, I get my $1,000 back. So that's your, that's your coupon, that's the par value, that's the basic bond, right? Well, in real time though, if interest rates go to 7% on a 10-year instrument, if I have to sell that bond today, nobody wants my bond that has a 5% coupon rate.
Right.
Because I can get a new one at 7%.
Right.
So now that bond must be sold at a discount in order to get that liquidity. So I can't sell it for $1,000.
Right.
I'm going to have to sell it for, you need a bond calculator to find out the exact calculation.
Right. But less than what you paid for it.
Less than what you paid for it. And the longer that maturity date, the bigger that discount's going to be. Right. So if you're buying a 2-year treasury and interest rates go up 0.5% year over year, not a huge deal. Right. You buy a 30-year treasury, and you're going to have serious problems.
Right.
Because you're stuck earning that lesser yield, theoretically, for 30 years.
30 years.
Exactly. So specifically with Silicon Valley Bank, and I haven't dug as deep, the Signature, they had a lot more crypto exposure. I think things were a little bit different with them. But Silicon Valley Bank in particular, hilariously, bought, it was all 30 years.
Yeah.
It was all super long maturity, super low yielding debt, because obviously 4 years ago, 2 years ago, 3 years ago, interest rates were really low, which is why you would buy a longer maturity, because a longer maturity it's riskier, so it should have a higher yield, theoretically. And when interest rates went up, well, And so at the same time, they had deposits leaving. Now they don't have, what they needed to now sell to get to those deposits had lost a tremendous amount of value relative to what they were legally by our accounting standards and regulations, but they were legally reporting the par value because their intent was to hold it to maturity. But if all of a sudden you have to sell any of it, that whole bucket gets marked to market.
Right.
And so all of a sudden, let's say it's $1 billion in 30-year U.S. Treasuries that you have valued at $1 billion, and you now have to sell $1 of that, any of it. That whole $1 billion portfolio immediately gets marked to market, which might now be $700 million, right? Now your ratios, which are required by the FDIC, right? I mean, you can't have X number of dollars of deposits,
Right.
And half that in assets securing that, right?
Right.
I mean, you've got to have a tremendous amount more, and so essentially, they were just completely exposed,
Right.
completely exposed. And from a risk management standpoint, which again, we'll get into that rabbit hole more, because it's pretty hilarious. From a risk management standpoint, they had just completely failed to see what was coming, that had been long telegraphed by the Fed. Hey, we're raising rates, we're going to raise rates, we're going to raise rates, inflation's bad, we're going to raise rates.
Right.
They made no corrective action whatsoever.
Yeah, and I think it probably stems from the fact that their projection was that they're a very tech-heavy bank, that they didn't think the tech party was ever going to slow down. So maybe they thought 30 years, we'll still see this influx of VC deposits, and we might be okay. Or did you think their initial thought was it's safe to put these bonds, or you think they're risky or they're not risky?
I think there's two factors there. Well, there's three. So one, I don't think there was much thinking going on at all. Which
okay, fair.
Because I mean,
right,
you probably would learn this in your, I know I did in my freshman year econ, macro 101, how these things happen.
Right.
So clearly nobody took macro 101, but you can't become a CFO of a publicly traded bank without some, hopefully more than I have.
Right.
some
Background, experience,
securities
education.
licenses, a CFA. I don't know. What the resume of these guys was.
Right.
Apparently he worked at Lehman, so that is an indication.
That's a resume builder right there.
But so to me, there's a high degree of stupidity here.
Right.
A, B, the publicly traded, and I kind of referred to it a little bit about us as a company.
Right.
When you're publicly traded and you're CEO, CFO, whatever, if you're in that C-suite, you're an executive, a lot of your compensation is share price based. And so you have a pretty serious incentive to not show losses quarter to quarter, because that's what you're getting paid. Right? And so you go back 3-4 years when a lot of these treasury positions were acquired, and you bought the 30-year treasury. You didn't do a ladder. You didn't buy some 2 years, some 5 years, some 10 years, some 20. You didn't buy a ladder so that you had liquidity throughout the yield curve. They bought the highest yielding one.
Right.
And it's a U.S. Treasury. It can't go bad.
Yeah.
So again, they were allowed to do it.
Right.
And that at the time showed higher profits.
At what point do we? And I don't know if I looked into this. At what point did they acquire? Did they just continue acquiring those treasury?
Yeah, continuously. Yeah.
Continuously buying those, even though, like you had said, they were basically. It was broadcasted that the rate was going to change. It was going to increase.
Well, banks are consistently participating in every market, right?
But I'm saying it didn't seem like they ever wavered from that strategy.
Hard to say. But I do think, and this would be a question about the banking system as a whole. How prevalent this behavior was, which is
that's a fair question.
We could look. You've got to think we had no interest, right?
Mm-hmm.
Inflation was 1 point something for 10 years after the Great Recession, right? And so 30-year Treasury was yielding nothing, but the 2-year Treasury was yielding literally nothing. And so I just think that for a decade, they'd acquired an increasingly high concentration of long maturity debt, because that on paper showed greater shareholder return.
Yeah.
And by the time rates started going up and it was telegraphed that rates were going up, instead of facing the music at that point and starting to show what would have been certainly less significant losses on the balance sheet, and going ahead and marking that to market when the Fed had raised rates the first 50 basis points, not 400 later. Right. And so I think that's the the way to look at it is that, look, they were continuously accruing these positions. This didn't happen all at once, but the failure of risk management came when the Fed was telling everyone, hey, inflation's a problem. We're going to be raising rates.
Right.
And instead of going, all right, we need to cut our losses here. We need to liquidate as much of these positions as we can to now ladder out our bond portfolio.
Right.
They just didn't. They didn't,
Yeah.
And that could be the fact that they didn't have a risk manager hired for 8 months throughout 2022.
Yeah, that makes sense.
At all, which that's amazing. So maybe they were just asleep at the wheel, or maybe they were going, well, we've already, if we show losses now, our share price is going to go down.
Right.
And we got Jim Cramer saying, look at SVB, which if you guys really want to make money in the stock market, this is not actual financial advice, but there is a thing called the inverse Cramer.
Okay.
If Jim Cramer says something is
Endorses
good,
it?
it will implode. It will implode.
Non-financial advice, non-binding,
but this is not a financial recommendation.
but just something micro picked
Kinda
up on,
funny.
small trend.
Because he literally was like, a month before SVB collapsed, look at this bank, look at their profits, look at this, look at how their deposits are, and look how secure their balance sheet is.
Well,
which on paper,
right.
if you weren't looking at the underlying, risks there, if you're doing a very shallow dive,
Look great.
Yeah,
I thought I saw a thing that said like 89% of SVB's holdings were like all in like customer deposits or something, or VC deposits or something.
Well, so handful of you might be referring to there's a lot of statistics thrown around about it right now,
Which I also think is important that we like try and.
Yeah. So one of the figures I was looking at is that of their deposits, and yes, maybe it is 89%.
It was like
was
something
VC and founders, and
Yeah.
it very well could be. But another interesting figure for them in particular is that it was like 95% of their deposits were over the FDIC maximum, 250,000. Which, there's actually I meant to text it to you earlier. Michael Burry,
Yes.
the Big Short.
Big
right?
Short, yeah.
He's another great guy to follow on Twitter and Instagram. He posted this kind of, and he always does things in a somewhat esoteric way, but he just posted this graph, and it was percentage of deposits held over the FDIC limit on the y-axis, and on the x-axis it was unreported. So basically, all the mark-to-market I'm talking about, banks that had unreported losses. So where all their balance sheet is showing these held to maturity, valued by FDIC rules, by accounting rules, not illegal. Might need to be looked at. But so they looked at that graph, and SVB was way out here. Way out here. It was like 95%.
Wow.
Uninsured deposits. And then just way, way out there on the unreported losses. And that, again, I think that brings me to what I think is important to understand here, and we'll get to some of my frustrations with how the government's decided to deal with this. This is not demonstrative of normal banking practices. Like you look at that graph, and he just chose out regional banks. He didn't put JP Morgans and the big boys for the most part. But you look at that graph, they were the one. I mean, they're such an outlier. They're 8 standard deviations beyond everybody else. I mean, just completely ridiculous. Signature was super high on the uninsured deposits, but their actual unreported losses was not that bad. But again, I think the crypto exposure was And First Republic kind of similar. First Republic actually did have a lot of unreported long maturity debt that was part of the problem. The concerns about is the greater banking industry at risk here, I do think, should you take a look and consider, hey, if I've got $1 million, I'm over the FDIC limit, at least before the government did what it decided to do. If I've got that money sitting in this bank, should I, as a consumer, be a little more intelligent about that? Right? Should I be looking at a little more than just flashy the front of the webpage, or should I be looking a little more at what's the yield on their savings account?
Yeah, right.
Because that's the same greed that I personally think led to what happened at Silicon Valley Bank. That same greed applies to consumers too. If you go, oh well, if I'm going to get an extra 0.1% on my money market account at XYZ Bank, well, you should be thinking about why and how are they offering that higher yield. Right. I mean, are they doing that because, wow, they're just so profitable? Or, are they doing that because...
want to entice, people to bring their money there because they essentially need deposit.
And so that's the other part of this is, so the government steps in, right?
Yeah, right. Let's get into that.
Government steps in and goes, look, we're wholesale, forget FDIC limits, forget any consequences whatsoever for, poor choices, and bails out all these companies. And you had like Roku, for example, I think had $500 million.
$450 million just straight up liquid in that bank.
And that's their payroll, that's their money for this, that's their money for that. I get it it's a hard thing to go, well, sorry, Roku, you need to wait for the bankruptcy proceedings to see what you get,
That's bananas.
That's a tough ask. But at the same time, I do think there needs to be a degree of culpability also for depositors. Because if you're a company, publicly traded company, you've got a CFO.
Yeah.
Right? You've got these people that should also be doing internal risk management to your company.
Just general practices, if anything.
Should you have $500 million in a bank that's all of its clients are in the same market?
Yeah.
So if one thing starts sinking that market, all those clients are going to start needing to get to that liquidity?
Yeah, it seems fairly irresponsible just in that regard. But what seems more irresponsible is that a company could do something like that and then immediately at the drop of a hat based on where your money is parked. And I think people don't actually realize that. They just consider the liquid and the cash in and of itself, not realizing where it's parked and why you should be asking the questions you were asking.
It's one thing though, and that's why the FDIC maximum existed.
Right.
And maybe 250 needs to be addressed, right? I mean, inflation, 250 20 years ago is not 250 today.
I was going to say.
Does $1 million depositor, should they be sophisticated enough to look at a bank's balance sheet? That's a question to ask, right?
Or at least have someone who is
But if you were the
responsible.
CFO of a publicly traded company, should you bear no culpability to look at that? I mean, that seems to me the fact that this is not a taxpayer bailout. Let's face it, we are all going to be paying for this.
Which we'll get into,
That's laughable. But, should we all be bearing the consequences of what was a hyper-focused, hyper-centralized problem with one bank and, frankly, a community in the Silicon Valley area, in that founder startup VC community that literally told all their founders, don't bank anywhere else. Don't bank anywhere else.
Yeah, right.
Put all your money in this pot. And then when stuff started showing, they had a memo back in January, I think, that kind of started to expose what some of the problems were. Obviously, higher interest rates, and we'll get to what's going on there, but higher interest rates has starved new capital from the VC space. These companies have to make payroll organically. So now they're drawing down money that they had raised in various capital rounds and things like that. And so it was within that community, too, that they said, panic, pull your money out of Silicon Valley Bank. They caused the bank run as well. So they told all their VCs, everybody was told, put your money all in this basket. And then they precipitated the bomb that blew up the basket. Now, the bomb was going to go off sooner or later anyway. If interest rates keep going up, it was inevitable, and they're probably going to keep going up. But yeah, so that there's a lot of questions to be asked in that space. But the wider banking system isn't doing
this much.
What Silicon Valley Bank is doing. So banking collapse I think is a little overblown. And, now the Fed has basically stepped in, FDIC's basically stepped in, Janet Yellen stepped in and said, screw it.
So let's get into that. So basically this is why it's important, and this is why we're going to get to not taxpayer bailout when theoretically it is, just indirectly. So let's talk about how the government handled this.
Yeah, so a couple things. I mean, they created a temporary lending facility. This is kind of one of the more systemic things that I could imagine stays, isn't a temporary thing, that essentially allows banks to, in a liquidity crunch situation like this, it allows them to to borrow from the Fed. It allows them to borrow money from the Fed based upon a collateral value of held to maturity.
Basically, once that bond hits that whatever the maturity of that bond is, which now you get your money back.
Right. So basically, the very problem of what they did and what their exposure was they needed access to liquidity. Now they had to sell held-to-maturity instruments to get that liquidity.
Right.
And when you do that by accounting practices, now that whole bucket has to get revalued. So now what they're doing is the Fed's basically saying, well, so let's just forget that on paper, they're fine, but in reality they're not. Let's just continue that illusion. And it's my understanding they're giving them 12 months to
borrow that.
To borrow and pay it back.
Yeah.
But here's my problem with that. Okay, after 12 months, let's say interest rates are still higher.
You're
just kicking the can down the road.
Yeah, right, exactly.
How's this any better? Now, in the case of Silicon Valley Bank, they're also essentially just guaranteeing all depositor funds. Just
right.
So $450 million for just Roku, right? Guaranteeing it. And the other tricky thing of that to me, well, handful of things that concerns me. If I'm a CEO, CFO, risk manager for, a Frost Bank, I want to come back to Frost Bank in a minute. It's a Texas, big oil and gas player. If I'm Frost Bank and I'm like, well, I'm a pretty big bank, so chances are my depositors will get bailed out if my bets go south. So let's bet. And I'm compensated based upon share price, and I'm held liable to every quarterly meeting to say, hey, look, we hit our earnings targets. Why the hell would I be responsible?
Yeah.
Why the hell? And frankly, it's the same thing that happened in mortgage-backed securities leading up to 2007-8.
Right.
There was no...
Simple explanation would be risk-reward.
Risk-reward, right?
Yeah.
So basically, you're telling all these banks, and, you call this moral hazard, okay? And it's funny, I think it was Powell, or might have been Yellen, said, well, now's not the time to think about moral hazard. Oh, okay, well then when? Are we gonna think about it? But what moral hazard is essentially is, you've created now an incentive structure that is,
de-incentivized responsibility.
Right, counterproductive, de-incentivized responsibility, and that's exactly the case here. You're basically saying, look, go for the YOLOest bet you can make, and pump up your share value, pump up your personal compensation.
Right.
Your incentive is to do that. But now there's no risk.
Yeah, basically, because if it does fail, it goes south,
right.
We have a program that will help us out and we'll figure it out. And
right.
Don't worry, taxpayer, it's fine.
It's not
you paying for it, which in reality, let's move into that space. Why indirectly are those people paying for it?
So here's how, and I talked about it a little bit, but, banks, so the FDIC, Federal Depository Insurance Commission Corporation, the FDIC guarantees deposits by charging an insurance premium, essentially, to all banks based upon the amount of deposits they have, okay? Well, what they're saying they're going to do to fix what's happened here is they're going to charge more to all those banks for that insurance.
It's going to increase that insurance.
Right. Well, who do you think those banks are going to charge that charge to?
Right.
They sure as hell are not taking it out of the CEO pay.
Right.
They're not sure as hell not going to make the shareholders bear that brunt.
It's just going to trickle down to
monthly fees. They're going to decrease the interest yields they pay consumers. It's going to trickle down to consumers. Period.
Who is the taxpayer?
Who is the taxpayer? Yeah, unless you happen to be, a foreign national. You guys are good. You guys are fine. Don't worry about it.
Yeah.
Well, no, Actually, no. Foreign nationals they're not taxpayers, but they would be paying these fees. So yeah, stick it to the 2% in international deposits that exist in American banking. Whatever. The other question I think too, and this goes to kind of the inflationary situation. We're raising rates. We're decreasing the size of the federal balance sheet. Okay, that's all well and good, but then this lending facility, it is the Fed, it is the Treasury providing that facility. If those one-year loans go bad, well, then the Fed's they've got to be printing money,
right? Yeah,
for that
right.
Facility. I don't know where that. So, and that's of course, I guess if FDIC insurance premiums are significantly increased, maybe that offsets it to a degree, But if you've created a system where all bankers now have an incentive to behave poorly.
What do you think is going to happen?
What happens down the road when, something that is actually systemic happens. Because
Right.
again, this to me was not systemic. I'm very concerned about what they've done to fix it.
Right. Well, that's what I think is now a question is, do you have just general concerns now moving forward with these fixes, these little things that are happening? Do you think we are kind of setting up without creating chaos? Do you think we're kind of setting ourselves up for even riskier things that have happened in the past?
I mean, look, none of this happened with any legislative oversight whatsoever, right? These are all unelected officials and bureaucrats making these decisions.
Right.
So there's that. If there's not some legislative intervention,
right.
yeah. I mean, now, is that 10 years from now? Is it 50 years from now?
Right.
I mean, who knows? But, you look at the mortgage-backed security problem that led to 2007, 2008, that implicit guarantee, that kind of, hey, yeah, Freddie Mac, Fannie Mae, and the private mortgage-backed security market, not Ginnie Mae, VA loans, FHA loans, that started in the LBJ administration. So it took 40 years
It took a while,
for that bomb to blow up. And so, I don't know, but bad incentives create bad behavior, period.
Right.
So
whether it be short-term, long-term, yeah.
So yeah, that is definitely a concern I have.
Do you? So then you would say this is almost seems to be a short-term solution for a potential long-term problem at this point.
Yes, very much so.
Yeah.
Very much so. And I wish, if I were king for a day, and what the administration's thinking was on it, or whatever, not to get into politics, but what they should have done is respected the consumer,
right?
And said, well, look, guys, yes, you've got a few banks showing some wrinkles. Yes, this is the second largest banking failure in the history of the United States. Setting aside Credit Suisse because that's a whole separate thing. But they could have said, look, here's the deal. These guys were idiots, greedy idiots,
right?
But idiots. This is not a wholesale contagion to the financial sector, because your bank that you bank with down the road,
right,
that does vanilla commercial real estate, does mortgages, stuff that's pretty vanilla, and mortgage, at least consumer mortgages are thoroughly regulated now. I mean, it's a very different animal altogether. They could have taken that opportunity. I don't think there was a bank run. We weren't going to deal with a wholesale, everybody's running, trying to stick cash in the mattress. I mean, you had an opportunity to head that off responsibly, deal with what's going on with these banks specifically, figure out a way, create some sort of function for the Rokus to make payroll. They're going to get some money. FDIC doesn't just give you $250.
Yeah, right.
It also then gives you kind of an anticipated value of future bankruptcy. They should have forced the bank into bankruptcy. Right. They should, and what they do basically is they'll say, okay, well, here's what the anticipated value is. I'm sure there's some margin for error there, but they'll basically pay out pro rata, like a coupon for what you're worth at that point, in a liquidation type scenario, is my understanding. There's a system for that, and they just didn't. They just said, yeah, okay, well, it's all fixed. Well, no, you just now you've just created a whole other thing. Then the other piece of it, and Yellen's hearings have been really amazing, because then kind of to rebut what I'm saying, what this is, rebut. To rebut what I'm saying, she kind of said, well, this is only going to be for systemically important banks. We're not doing this. This isn't just every bank.
Who decides what's systemically important?
I guess Janet Yellen does, the Treasury Secretary, an unelected position.
Right.
And so, again, there's no metrics for that. There's no...
Right.
So then think about the incentives that creates.
Well, I was going to say that opens up a whole different lobbying sector for these banks to appeal to.
And so Frost Bank, and not to be overly political here, but, so you've got a Silicon Valley bank. Look, I didn't want Cade, Odette, Plump Jack to fail. I'm a big old cab guy. Those are good wines. Yeah. Big fan, right? But it's Gavin Newsom's bank. Right. The fact that, Silicon Valley Bank, if it collapsed, it'd be the apocalypse, and it's clearly systemically important, and it's da-da-da-da. But you've got this tech money, super tech-centric bank, and, they get rescued. Well, what about Frost Bank? If Frost Bank disappeared from the oil and gas industry, it'd be a problem. Mm-hmm. Well, we don't like oil and gas. This administration doesn't, right? So okay, well,
are they going to run to the aid? Yeah.
No,
They're just
well,
gonna be like,
sorry, you're not systemically
let
important.
the chips fall where they may. Yeah.
You are. So it creates this. And again, the fact that there's no metrics, at this point, there hasn't been, I'm sure there will be, but this is what the legislature's for. Right. I mean, to make laws.
Right. And it's not opinion based on who's in the White House.
Because that's, who appoints the Treasury Secretary. So every 4 years we get to choose which banks are going to fail, which ones are going to succeed. I mean, that's you don't have to be politically on one side or the other to go, well, that's not great. That's not great. That's not good.
Not great.
It's not great. Yeah, it's a weird thing. And then the other factor here is, okay, so now you're a true community bank, right? You're never going to be considered systemically important. But those banks are the banks that actually lend to the hardware store down the road, to the plumbing company that wants to build its new building. Like, those banks are vitally important to the everyday working American, certainly to the small business owner, and they don't really have a lot of depositors over 250,000 because they're small town banks. Right. Well, she explicitly said, well, no, not you guys. So she's going to raise FDIC insurance premiums for all those banks, right? For no guarantee, right? For nothing. So it's just, it's on the face of it, to me, it's just really perverse. It's kind of a mess. So we'll see. And I'm sure, this will not be the last we hear on it, but at least on its face right now, it's kind of a mess. So,
well, let's take this then into the space of where it kind of does or doesn't affect when it comes to home buying or selling, right?
Sure. Well, and we've seen more interest rate volatility in the last 2 weeks than you probably see in the average 5 years. I mean, it's just been all over the place the last couple of weeks, because you had the Fed on a steady course of we're raising rates. We get this bank collapse thing, to me overblown, again hyper isolated to some certain sectors. Maybe not, the Fed knows something I don't, but now that suddenly rates drop again, and at least market rates drop, because all of a sudden the expectation that the Fed might do 50 basis points yesterday, they might do 0, at worst they'll do 25. So you saw this big pullback in interest rates, and then all of a sudden it's fixed, right? The Fed's, we're going to solve it, we're great. The whole Credit Suisse thing, they get bought out by UBS. That's a whole funny saga too. So now rates shoot right back up. Then Powell's remarks yesterday, okay, now rates are back down a little bit. Because, okay, well, we are acknowledging that there might be some weakness in the banking system. That is going to lead to some credit tightening. That credit tightening in turn, is going to accomplish what additional rate hikes might accomplish. So I love the verbiage. So they changed the verbiage in their minutes to ongoing hikes being anticipated to, probably some firming up of hikes, which is, just hilarious. And someone actually asked the question.
So between firming and anticipation, almost.
Yeah, ongoing hikes versus firming, maybe kind of sort of some hikes. And this guy asked, like, what's the difference between those two things? We're like, well, one is ongoing and the other is,
we'll
play
it as it goes.
what we're already doing. It's like, well, isn't that what you were already saying you were doing? So the fact that the market has kind of reacted very quickly to this and rates have kind of fallen, I don't know that that's all that sustainable.
To me, it just sounded more of like a play it by ear situation.
But that's what they've been saying this whole time is, we're going to wait for the data. We're going to wait for the data. On the other side of things, look, unemployment's still really, really low. Some of that doesn't make a lot of sense to me either. When you hear all the layoffs that are being reported, and yet, job growth is still here apparently. Okay. But unemployment's still low.
A lot of banking jobs opened up.
Not so much. But unemployment's still low. Inflation is still high. Supply chain's still a mess. There's a lot of stuff that I don't even think we've even seen yet in the supply chain space. I mean, the effects of. Powell, I think, was very. He's like, look, you should not expect us dropping rates. Over the next year. I mean, there's just no chance.
I think that was built too, and that's why they go to this, like, they want to be able to give people some sort of projectability, but at the same time, they're so unaware that they're like.
I I just think they don't want. I just think they don't want to spook everybody. They don't want that big old market sell off. You know?
Right.
Yeah, it's just a really strange situation. So for the average home buyer, you know, you want to try to get lucky with the dip. Right. And we're going to see rates trading likely in this range for some period of time. I personally kind of think that once this all kind of gets worked out, you know, if we get a really low inflation number, that's for sustainable trends in the right direction. We need months, you know, sequential months of inflation retreating. And as long as we're seeing that, that's what's going to create that kind of sustainable interest rate decrease. You know, if you're thinking about buying a home and you're saying, oh, well, you know, it's the apocalypse and all the banks are failing. And it's, you know, again, I'm not thrilled about the consequences of what they're doing and what that might mean 10 years from now.
Right.
If nothing gets addressed legislatively. But
it's still safe to say
job market is still strong.
Right. If you need to buy, you buy. You need to sell, you sell. You're not, for the most part, you shouldn't unless you bought in the last.
Now, if you're unemployed, yeah, obviously you probably can't buy, but you know, I mean, if you're having financial distress, well, then you probably shouldn't be buying something. If you're expecting financial distress, you know, don't buy something you can't afford. Right. That's the case always.
Always.
You know, so do some of these ripples maybe make you think that through a little more aggressively? But it's not the apocalypse.
No. Yeah, and I think that's what people's primary focus was, that this house that I just bought, is it basically, am I going to lose my shirt on it?
Well, think about this. So, you know, for the first time in, 12 years, we saw home prices retreat. They fell for the first time in 12 years, in February, month of February. However, new mortgage applications and existing home sales exploded to higher than at any point in the second half of 2022. So what that tells you is that, you know, and of course interest rates did retreat for a little bit that month. But so what that tells you is, okay, well, the second rates go down, everybody's jumping into the market, right? The second that home prices retreat just a little bit, everybody's jumping back into the market. Yeah. And so if you look back at 2007, 2008, well, that wasn't what was happening, right? You know, what was happening in 2007 and 8 is
just bad loans.
I mean, bad loans all imploding across the board, right? And, you know, a bunch of people that bought homes they could not afford, a bunch of people that bought homes speculative they have no intention of living in.
And that's because of the adjustable rate mortgage for
part of it,
part of it, which is that you buying a home, which your payment's this, and then at a certain point it will turn up, and now you can't afford to stay in that home or even keep that house because you can't meet.
Yeah, I mean, yes. So yes, those pick-a-pay mortgages we talked about last time. You know, how that certainly that motivated consumer behavior, but it was also consumer behavior. You know, they saw month-over-month increases in housing prices, and you had this whole flip market existing. You know, people had no intention of even trying to put a tenant in these houses. Right.
They were just like, I'm buying it.
I'm going to sell it for $50,000 more the next month. You know, and so I'm actually pleased to see that we've seen this leveling off in housing prices. I mean, Florida, obviously, we've been a huge net recipient of migrants over the last several years, and continue to be. I mean, there's just no shortage of conversations I have about that with people. So, you know, the fact that we've had this taper is, to me, a relief to a degree, because you've stopped that behavior. Right. You know, and that's why the Fed raises rates, right? That's why they do what they do. That's the point.
That's the goal,
Yeah, that's the goal, is that you want to cool off speculative, irresponsible behavior. And, you know, again, most of these houses, certainly the ones I'm financing, I haven't done a flip because you can't really get financing to do a flip. Right. You know, you've got to qualify. You have to be able to afford the payment. You know, the occupancy type has to be established. And it's not the same world we were in before. And so, you know, while, yes, I mean, if the Fed overshoots and we do get unemployment and things, you know, sure, could you see home prices ease up? But the fact right now, I mean, at least in Florida, because I don't necessarily think I saw prices really decline in Florida in February. Year over year, probably not.
And if they did, it was more of like it's not the gold rush anymore, so let's actually price this accordingly to where it should be.
And then, like I said, I've been on fire. I mean, I've been insanely busy. And so I just think that continues to support home prices to a degree. I mean, look, if you're buying a house today and you're losing sleep at night next year, if you've lost 10% of your value, then you shouldn't be buying a house. Right. Now, you know, because I live in my house. and I mean this for primary residence. I mean, maybe if you're looking at investment properties, or if you're buying something, certainly I don't think it's a flip market unless you've happen to be a contractor and you happen to be really skilled.
I'm saying you can get something
can control your costs in a way. You've got that you're paying cash. But if you're the kind of person who really cares about year-over-year paper losses, I would say that's not a great way to do business in general.
Right.
Certainly when you're buying something that's so transaction cost intensive like real estate, it's like it doesn't make a lot of sense. But if you're a homeowner buying your own house, certainly if you're a renter getting out of the rental market and buying a house, if you can afford the payment, what's the difference?
Right.
If you lose your job next year, that's a different deal, right?
Right.
But otherwise, what's really the difference? I mean,
right.
We've talked about this before. My house is worth 4 times what I paid for it. It's probably now worth 3.5 times what I paid for it. Who knows, right?
Right.
What? I sleep there.
Right.
I like where I live. It works for my life.
You need it. Yeah.
I'm raising my family there. It's like, I just think people get way too focused on that kind of thing. I mean, affordability is all that matters.
It discourages them. But yeah, so in nature of kind of wrapping up, because I think this is important and I think this is more of our customer base, is you said it first. As soon as we saw this dip, we saw this influx of mortgage applications, right? Which I think is important. This is a crayon, not a cookie. But if you need to buy, you buy. Here's the greatest part. If that rate dips, how do you respond with that? By refinancing. Right. So I think it's important that people understand that whatever the rate is now, it's set there until it either goes up or down.
Right.
If it goes up, you're good. It goes down, refinance, and you can get that lower payment. Right? And I think that's what's important for people to understand, is that this wonkiness and roller coaster of like, are they going to go up? Are they going to go down? It's only going to affect you if you are buying at that particular moment. If you've already purchased, or you're moving forward, or even if you need to purchase and it is high, you need a house. You need to live there. You need to raise your family there. You need a house. You need to buy. Right? It's always okay to buy when you need to buy, sell when you need to sell.
Right.
You might not be the overall outcome you had hoped for when you initially bought, when you sold. You're like, I really thought it was going to be that. Whatever. But if you need to, you need to. Right?
Well, and it does affect affordability, right? I mean, so when rates are 3%,
for sure.
And if you needed a house that was a certain kind of house, I think want and need, people really need to do a better job of differentiating. But so it does affect affordability. It means you can afford a different kind of house.
And that's what I thought I had saw. It was like back when the rate was in the 3s or whatever, you could buy a $600,000 house and the payment would be the same as if you bought like a $340,000 or something. It was something bananas.
Like 400 now, but
right. It was something bananas, which again though is that's where this whole saying that every real estate agent was saying is, you date the rate, you marry the house kind of thing.
Yeah, and I don't love that, frankly. Because I think all too often that does have the negative connotation of overextending yourself.
Well, yeah, of course.
I'm look, if you can afford afford it at this rate, then things can only get better for you.
I love that.
Right. If you cannot afford it at this rate, do not sit here relying on, but I know next year I can.
Yeah,
because I'm still not comfortable with that bet.
That would be terrible risk management.
It would not be good risk management.
That would be terrible risk management. It would be buying a $600,000 home, knowing you can only afford it for a certain amount of months, years, and hoping that the rate was going to dip, you were going to refinance, and then you were going to get
It sounds a lot like a 12-month credit facility from the Federal Reserve for your really, really bad maturity bonds.
Right. Yeah.
It's about the same thing.
Yeah. All right. Rad. Well, anyway, dude, thank you so much. I always enjoy talking to you. I mean, we chirp at each other all the time. I always get my financial news from you. My taxes, I can't wait to get those back from you.
I got you.
That's going to be awesome. Not sure how that Chinese food menu got in there.
I'm going to send my whole backlog of Credit Suisse memes to you, just so you know.
Sure.
Yeah, Credit Suisse, guys, has nothing to do with it. I mean, interest rates going up, sure.
Right. But this is not a part of that.
No.
We had discussed bringing that up, but it was more so far not ineffective of this. That I thought it just would have been, news at this point. It wouldn't have been really.
When the Saudi National Bank owns 9.9% of you, things might not go well
at any given time.
at any given time.
But anyway, thank you very much. Cross Country Mortgage, they're one of our great partners and our preferred lender here at DJ&Lindsey Real Estate. This podcast is also sponsored by Audible. Audible is a great way for you to listen to books instead of read them because you are talking to your underwriters, talking to customers, you're lending, or you're out showing homes. You can find our referral link in the description. It's tryaudible.com/DJ&Lindsey. Coop, thank you, brother.
Well, now I think it's time for Coop's Corner.
Coop's Corner. Thanks, guys.